So hello and welcome to another episode of the Creative Real Estate Podcast. Today, I'm extremely excited to have our star guest on the show. We've got Yonah Weiss. Am I pronouncing that correctly?
Perfectly. I mean, with your South African accent, however you pronounce it is correct.
I like it. So we're extremely excited to have you on the call today. We're going to be specifically diving into cost segregation and all of the tax benefits that real estate owners or investors are able to participate in. I think that it's something that's to a large degree really not spoken about enough for those that aren't in the space. So talking about people that generally deal in the listed environment where they're just buying stocks, they're not necessarily exposed to any of these benefits that you see as a direct owner, and very few people actually take the time to compare returns on the basis of what actually happens on a post-tax basis. And I think that a lot of them miss the real opportunity in direct property ownership. And when you compare apples for apples, which is what most people should be doing, they need to really take a return metric and look at it post-taxes. So I'm extremely excited to have you on the show today, and maybe you could share a little bit more about yourself, your background, how you got into this space.
Thank you, Rikki. Yeah, it's a pleasure to be here with you. It's, a little about me, Yonah Weiss. I actually just launched Weiss Advice, my podcast today, officially.
Amazing.
Which is great. So I don't know when this is going to air, but you check that out. You can find me there. I've been in the kind of real estate industry for only about the past 5 years or so. So before that, I was a teacher, and I spent a lot of time studying and teaching with most of my day in nonprofit work as well. I had a nonprofit organization just helping needy families. But at a certain point in time, I needed to cover the bills and cover the bases. And it really made sense for me just to kind of look into branch out to other things. And real estate was just, for me, kind of a logical next step, because I thought to myself, hey, I know a lot of people, I have a lot of friends who are in the industry already in various capacities. I may as well, kind of pick their brains and see if I can learn from them and kind of apprentice certain things. So that's how I started. I actually started with a good friend of mine, apprenticing him really in commercial mortgages. And that's how we know, mutually, a friend, Yonah Tilson, was from those days when I first started out just getting my feet wet in commercial mortgages. And, from there I moved on to residential fix and flips and brokering. I wanted to get my feet, literally learn everything about real estate in the industry. So instead of listening to podcasts like you may be right now, I reached out to friends that I knew that were doing it and just wanted to tag along with them in different capacities. So at a certain point, about 3 years ago, I was approached by this company, Madison Commercial Real Estate. They were looking for someone to run the business development and to be involved in the cost segregation business, which was intriguing to me because it has to do with taxes. I've always been about helping people and how we can do, so this was like an opportunity to help people by, helping them save taxes. And it was still within the real estate industry, and it got me very deeply rooted in that. So that's kind of where it's led me today. So I'm very fortunate to be with Madison Specs, the biggest national cost segregation company in the country. It's just incredible. I get to speak with and meet with and rub shoulders with literally all of the, the best people, most successful real estate investors, around.
I think it's interesting that you came from a kind of commercial mortgage background. Well, initially teaching, but when you started getting into real estate, you dived into the commercial mortgage side, and then you got drawn into the tax sector and just understanding all of that work. Maybe you could give us a high-level point of view for anyone listening. What exactly is cost segregation, and how does it tie into depreciation and all of these different words? Where do they come from? How do they fit together? And essentially, what's in it for me?
Like you said, cost segregation is really an advanced form of depreciation. If we understand what depreciation is and how that works, we can really, cost segregation just makes perfect sense how that works. So let's take a step back there and just understand depreciation, because it sounds like something negative, right? Something going down in value, which is what the real definition, if you were looking Webster's or whatever, an asset that's going down in value is depreciating. But when we're buying real estate, most of the time, our goal is, and our hope is, and the reality is that property goes up in value as time goes on. It's appreciating. This concept of depreciation shouldn't be thrown off. It's hypothetical. It's just a borrowed term. And what I mean by that is like this. When you buy a building, the IRS, the United States Tax Code, Internal Revenue Service, gives you a tax write-off, an income tax deduction of the entire building, the entire property. Okay.
Wow.
When you buy commercial property, anything that's not your personal residence, business, or investment, you can now write off the entire, it's a tax write-off. You buy commercial property, tax write-off. That's called depreciation, because they say that you're investing money, you're putting money into this building, but really it's going down in value. So we want to give you a tax, a loss, for the amount that it's going down. But it doesn't make any sense, because first of all, it's not as good as it sounds, because they don't give it all to you in 1 year. You have to spread that over a 27.5-year period for residential, or 39-year period for commercial, which means, if you buy $1 million building, you subtract a little bit for land, which doesn't depreciate, and then the remaining amount, you can take a tax deduction, like I said, tax write-off, a little bit every year for 27 years. So again, it's not like you get the entire amount in 1 year, but you do get to write off that entire amount.
Absolutely.
Whereas really it's going up in value. It tells you that it's really going down in value from a tax perspective, which allows you to take these deductions. When you think about it like that, and the reason why I say it's hypothetical, because it's not intrinsic in the building. If it were, then, if a building was built in 2004, right now we're 16 years after that. So that building has already been 16-year depreciated. Okay. Which means if I go and buy the building today, I'm only allowed to take, a remaining 11 years of depreciation of that building. But that's not so. That's why I say hypothetical, because when you buy a building, depreciation schedule starts over from day one.
And that's the real beauty.
That's the real beauty. And that's why it's hypothetical, because it's not intrinsic in the value. Okay. So this is where people get thrown off a lot. So depreciation is a really, really good thing from a tax perspective. It's not really
when it's real estate, real estate, right? And that's why we like to buy real assets like this. I suppose if you bought a car and you had depreciation, you would maybe really see that happen and play out, which I think is
correct. Yeah, that's and really this is where we're getting into cost segregation, because other equipment or other things that are not real estate actually do have a useful life. Okay, and that's where this term comes from. Depreciation. It's what is the useful life of the object. So equipment, a car, for example, or furnishings, things like that, carpet, a roof, there's a real useful life to it, which is a lot less than 39 years, okay, or 27.5 years. So that's where the concept of cost segregation comes in. Whereas the building and the structure, the IRS says you can take as a tax write-off over this long period of time, other things in the property that are not considered structural, okay, so personal property, which can include anything in the building, like, that's not attached. So even stuff like carpeting or cabinets that are not permanently affixed, because you can pull them out, it doesn't ruin the building. Furniture, equipment, appliances, countertops, all kinds of things, fixtures, window treatments, all kinds of stuff like that. Even millwork, that actually can be depreciated on a 5-year schedule, because the IRS says all that stuff really has only a useful life of 5 years. So now you can take that as a tax write-off by doing a cost segregation study. Okay, so the process of that is identifying what those objects are and then taking them as a faster tax write-off. So that's cost segregation in a nutshell.
I want to touch on two things that you mentioned there. So you had 39 years and you had 27.5 years. And what's the difference? What gives?
I think, it's just commercial buildings that are not, multifamily or residential, they must last longer or something. Maybe there's less wear and tear from, a tax perspective, which, you can see that there may be less wear and tear in a commercial property. But I don't really know where they came up with these arbitrary numbers. And why, a multifamily property is considered commercial for other purposes, and it really is a commercial property, but for tax purposes, it's considered residential on a shorter schedule, more tax benefit that way. So I don't really know where these numbers came from, but that's what they are.
That's it. Sometimes I think it was Buckminster Fuller that said, you don't fight the system, you work with the system. And
that's exactly right.
We're aware of the system. And I guess the residential side, as you mentioned, is 27.5 years that you get to depreciate the value of the asset for, and all other commercials, 39 years, correct?
Correct.
So on the cost segregation side, that kind of leans me into the next question. And maybe we can touch on two separate focuses. So we've got the multifamily side and then we've got the other commercial. What are some of the common cost segregation line items that we like to use accelerated depreciation on multi, and what are some of the common items that you would see on a commercial building?
So again, as I mentioned, there are things that are in the building not considered structural, depreciate on a 5-year schedule, and that's considered personal property. I'll give a couple examples in a second. And then you have something which is called land improvements, which all buildings have as well, which are things outside of the building, which would include, and that depreciates on a 15-year schedule. So those are the main two categories. The 15-year land improvements would include anything like parking lot, pavement, asphalt, landscaping, fencing, retaining walls, anything that's outside of the building that actually has value to it. So besides for the land itself, right, which we mentioned, land does not depreciate. So you have to always have a value, assign a value to that. Anything that's on the land, which can be a tremendous amount of things. When you think of landscaping and parking lot, all that kind of stuff. Those are some examples. And for certain types of commercial properties, you have a lot more of that. Like you think about a shopping center, a strip mall, something like that, where you have a large parking lot, you have large signage, and all of that has value to it. That be assigned a much larger value to those things to be written off at a faster rate. Now, whereas the personal property, the 5-year property, residential, again, stuff like furniture, appliances, carpeting, cabinets, all that kind of stuff. Even things like millwork, right? What I mentioned before, and special purpose lighting. So if you have, LED lighting, or you have certain type of spotlights and things like that, all that has that 5-year property assigned to it, which can be on a 5-year schedule. Commercial properties, again, there's so many different things depending on the type of property. If it's an office building, you'll have stuff that won't be in a residential building, like maybe telephone systems and intercom systems, security systems, where you may have that in a residential building, you'll have it much more so in a commercial building. All those things are not considered structural, and so you can write that off faster rate. Of course, any type of furnishings as well. Kitchens have a lot of stuff in it. So if you're in like a restaurant or a type of commercial kitchen like that, where you'll have the oven hoods and all of the appliances that are in there, there's a lot of value to that stuff.
Absolutely.
Depreciates on a 5-year schedule.
And so maybe it's difficult to actually package this into a simple answer, but let's just say, for example, I'm doing some underwriting, I'm trying to calculate my returns for investors, and I need a ballpark figure between valuing on a high level what we could get from a depreciation perspective. So is it unique within each state in the United States, or is it pretty much a blanket approach? And I know that I can take 80%, I'm just throwing a figure out there because I think that's what I've heard, is I can take 80% of the purchase price and assume that that's improvements on the land, and the other 20% would be land, and then work off that based on whether it's commercial or residential property, and formulate a depreciation schedule over 27 and a half or 39 years. How would I get some kind of a ballpark figure to know what my depreciation allowance would be?
The interesting thing is the IRS does not have any specific guidelines of where to assign value to land versus the improvements. Again, the land will not depreciate, and we'll not be able to use that from the purchase price. The rest of it will be, and that's where we're going to come up with depreciation. As you said, there are a few different ways that you can go about that, but none of which are, so to speak, approved, none of which are, declined by the IRS. You just have to have some sort of method. One of those is, you may have a third-party appraisal. Okay, so if you have a third party come in into the building and say, you bought this whole property, it's a 50,000 square foot property, on it is a 20,000 square foot building, right? The land is 10% or 17%, whatever that is, 20%. Yeah. You can also have sometimes the county assessor. So the county tax assessor, how it works in the States is that each county collects property tax. So they will come up with a value on their own based on the whole county. And so there's a percentage that they assign to it. And that's one way to get to it. A third way to get to it would just be to look at comparables. So if you were to know that land sold in your area, a certain amount of square footage or acreage of land for a certain amount of money, then you can come up with to see, well, how much is land worth? And then you can kind of work backwards like that. So these are a few different systems, all of which work to come up with that figure. Okay. Typically, we see nationally, the average is about 15%. 15%.
Okay. If I wanted to work out a figure that's not maybe bulletproof, but just to give me a rough guideline, I could allocate 15% of the purchase price to the land, and the difference I could then use to formulate my high-level depreciation schedule, and just get an understanding of that before looking at anything like accelerated depreciation and all of these other little items, which I suppose is where one would get a specialist such as yourself involved.
Yeah, absolutely.
What does it really shake out to? If I had to take a practical example and I'm buying a building for purchase price of, call it $10 million, what do I get to write off each year?
Perfect. So first thing we're going to do is we're going to look at that land, allocate allocation. So let's say, let's just make it simple. Let's say 15% to land. So we're left with about $8.5 million, which is going to be our depreciation. Of that, we'll have an engineer come out, okay, a cost segregation engineer who will come to the property and determine what fits into what category. Okay, so there's a whole tax code that delineates all these 5-year property, the 15-year, the personal property, land improvements. They'll come down and literally line item by tiny details, breaking down to the nuts and bolts of the building, come up with what's in there, and then come up with values, assign the values to those things, and then come up with calculations of what can be depreciated. So let's say we're, in your case, you're talking about a $10 million multifamily property. Okay, it's a garden style building. Let's say, I don't know, 200 units, something like that. And we're left with, $8.5 million we can depreciate. Typically about, let's say 20% of that will be found, after all is said and done, in the 5-year assets. Okay, so all the furniture and the fixtures and the carpeting, all that stuff, all added up together, let's say it comes to about 20%. That's giving you roughly about $3.3 million, just a rough estimate of depreciation that you can take in those first 5 years.
That's a pretty hefty number that you're able to deduct just off the first 5 years.
Sorry, that's 40%. I just doubled that. It's more like 1.5 million, right? 1.7 million.
1.7,
I was thinking 40%. So about 20% of that is about a 1.7 million that you can take literally in the first 5 years, or with this new law, which maybe we'll touch on, bonus depreciation, you can take that all in the first year, which means you can buy a $10 million building.
I was just going to say, now you got to touch. You can't just maybe we'll touch on. That's like we hook, line, and sinker here. You can't throw a bait like that and not expect us to catch.
Right, but so we want listeners to listen to the end. So we'll talk about that a little later.
Great, that's a great way to do it.
We'll get to the tax reform, and what this means to us a little later. But so what you're doing is taking, 20% of that, 1.7 million approximately, putting that into the first 5 years, which means you're taking extra depreciation in those first 5 years. So let me just break it down like this for a second, because I just want to take out my fancy calculator because I can't do all these calculations in my head. But if you were to take straight line depreciation and you were to depreciate this property over a 27.5-year period, that $8.5 million would translate to approximately $309,000 of depreciation every year. So regular depreciation, you buy a $10 million building, you automatically get from the IRS a $300,000 tax write-off against your income tax every year. So that's amazing.
Just so that I can understand that quickly, and for anyone listening, I'm buying a property. Let's say we're buying this thing for $10 million, and to keep the numbers simple, we're buying at a 10 cap, which will never really happen. And well, maybe we'll see it in the next few years as things continue to play out. You're buying it at a 10 cap. So essentially this thing's producing $1 million a year. Your financing's at 5% nowadays because things are more risky. So you're deducting that, and you're left with sort of, I don't know, let's call it half of it's still profit left, right? So you got $500,000 in net operating income after servicing your debt. And now I've got this additional $309,000. Was that the figure? $309,000 that we could deduct off of this income. And that's all that we're going to technically pay taxes on, right?
Yeah. Well, what's left over from that?
What's left over from that, yeah. So you're able to deduct this full depreciation from your net operating income or from whatever your leftover your leftover profit is in the property. You deduct that, and then what's available is what you'll be paying tax on.
Exactly. Now is when it gets exciting, and we add cost segregation to the equation, because originally we had a $309,000 tax deduction. Now we're adding an extra, $1.7 million of depreciation over those first 5 years, which translates to approximately $340,000 right, each year for those first 5 years. So we've just doubled, or more than doubled, our depreciation deduction, which obviously will have a significant effect.
Effectively
on
paying no tax
liability.
Correct. Unless you bought the screaming deal of the year or the century, you're not paying any tax in the first few years.
Exactly. So this is really where it gets exciting. And I just touched upon the 5-year property. There's a 15-year property as well, which again, the land improvements typically be, between 5 and 15% of a multifamily building. So you're going to have typically between 20 and 35% of that building will be depreciated, over at a fast. So you're going to get a lot of extra tax deductions. Now,
that's remarkable.
Yeah. Well, like I said, the bonus depreciation makes it more incredible because you're just front loading it all into into the first year.
So we'll get into that shortly. So for anyone listening, I mean, if you haven't been following anything so far, here's the one thing you need to understand is that if you're directly owning real estate, you're generating income from this. Depreciation essentially allows you to earn cash flow right into your pocket, and cash flow that you don't need to pay any tax on. So for anyone that's looking to compare it to any other kind of investment that is not directly owned, that is, so call it something that you're investing on the stock exchange or something along those lines, and it's generating a dividend, you're still going to be paying tax on that income, and it might be dividend tax and that might be slightly lower. But if you really want to compare it, you got to work out the after tax amount, because that's essentially what you're getting out of this direct owned real estate. So I think what's the downside here? Where's the catch? It seems too good to be true. What's the logic behind it, and where does the tax man get his money back?
Excellent question. So you're absolutely right? Nothing is, especially when you come to government and you come to taxes, they're going to find a way to, to try to get it back. They're not in the business of just like helping people. However, that being said, it is still pretty incredible, because taking advantage of this is really in your best interest almost all the time.
Yeah.
So two things. One, the real benefit here, we're not creating deductions out of thin air. What we're doing is we're front loading those deductions so that you can take advantage of them earlier on, which is really, when you'll need them. I don't know what's going to be 10 years from now, 20 years from now, 30 years from now. Will I still own this property? Will I not own the property? Will I need the deductions then? Maybe I'll have, income, won't have income. Now I need them. Now I want to pay little tax. You have an advantage to pay little to no taxes now. Okay?
Yes.
That's called the time value of money, using your money today and not waiting, to use it later on. And so you can look at it like an interest-free loan, because we're just taking more deductions now, it's not really an interest-free loan because it's really your money in the first place, but you're getting around paying taxes. So what's the downside? Two real downsides. Number one is that you may not even be able to benefit from these deductions, which is, creating extra deductions when you don't have income, right, is not necessarily going to help you. And furthermore, according to the tax code, there's something called a real estate professional. And a real estate professional is a specific term of someone who spends the majority of their working hours in the real estate trader business. Okay? So if you or your spouse fall into this category, that you're, you own property and you're managing that, you're brokering it, you're doing renovations, construction, operating, acquiring properties, any of all those things, and you're actually involved in that process, and you're spending the majority of your time, you don't have another full-time job, you're considered a real estate professional. What that does for you is that allows you to take all of these tax deductions to not only offset income from the properties, which normally depreciation is only used against passive income. Passive income is income from properties, real estate. With this real estate professional status, now you can actually use those deductions to offset all and any of your income, both yours and your spouse's income from any source whatsoever.
That's amazing. So what do I need to qualify for that? How do I get that?
So there's a few kind of stepping stones you need to get to. Number one is, again, you just have to have the majority of your work. So over 50% of your trader business is in real estate. So basically you cannot have another full-time job. It's pretty impossible to have a full-time job and also be a real estate professional if your full-time job is not in the real estate business. So it's either you or your spouse needs to qualify, and then you can use this kind of golden ticket against both of your income tax.
Wow.
The second qualification is that you need to actually spend, and you really need to document the time, spend 750 hours a year in these activities. So it's not a lot. It's about 16 hours a week if you break it down like that. But it basically means you can't, you actually have to track those hours. So, if you have a spouse that's a stay-at-home spouse, that will be a great opportunity for them to, maybe handle some of those hours in terms of, be a broker or be involved in acquisition, the management of the properties, but they still need to spend those hours in doing it. So it's not just enough to, spend more than 50% of your time. It also has to have a certain, substance to the amount of time being spent.
Let me take that question one step further for any other syndicators out there that might be wondering this. So as a syndicator, we typically, let me rephrase it like this. I think this is the easiest way to understand it. In order to qualify for depreciation in your personal capacity, whether as a passive investor or whether as someone active in the real estate space, do you need to make the initial capital contribution towards purchasing that property for your membership or ownership stake? Or is it merely a representation of what you own on the property even though you didn't contribute all the capital towards that. So as a syndicate or operator, typically they'll get, call it 20% ownership in the property, and the investor, the equity, they'll get the remaining 80%. Would the owner operator be able to participate in any way if they haven't contributed that 20% margin of capital, or would they need to have contributed that full 20% in order to get the benefit? And if they haven't, the investor will then receive the total 100% of the capital contributed benefit.
So that's an excellent question. The interesting thing about how depreciation works is the IRS allows you to take a tax deduction based on the purchase price. So when we look at it like that, and we understand that there are oftentimes many people who are contributing to buying the property, many of which who are not even benefiting from that depreciation, for example, the bank. Right? Yeah. You're putting down, you and your investors together putting down 20, 25% of that money, maybe more, but the bank is really contributing the rest. Nevertheless, you get the tax benefit of the entire purchase price. So that's the first thing to understand. The second thing to understand is it's an excellent question, because the answer is it really depends. And it's going to depend on how your operating agreement is structured. Most cases, the operating agreement is structured in a way that according to your percentage of ownership of that LLC, of that property, that's the amount of depreciation deductions that you get. However, there are some, opinions or some people that, depending on how the operating agreement is structured, that would say that no, it's really only considered according to the capital contribution, in which case a syndicate who doesn't contribute any capital, they have to make sure that their operating agreement states clearly that they still participate in the tax benefits because they own shares in equity. So again, it's all going to come down to how the operating agreement is structured and how that the tax benefits are going to be distributed amongst them. And there aren't too many ways that you can play with that to say, well, because you can't just say, well, I want the tax benefits, so I'm going to, write in the operating agreement that I'm going to get all of them. And, my friend, Jack is not going to get any.
He's not going to get it.
You can't really do that. It has to be based on some sort of, the ownership percentages, or that it can be potentially structured in a different way that maybe those investors are coming on as kind of like a loan component, right? As not necessarily as an equity component, and they'll just be getting proceeds of that to pay off the loan. So they may still be getting the amount of returns that they're expecting, those preferred returns, but not as an equity distribution.
So would it be fair to say that it's not a bad idea for a syndicator to actually have their attorney reach out to a specialist like yourself prior to writing up the operating agreement to make sure everything's been sort of laid out correctly? Because I assume once that operating agreement signed and sealed, you can't really work around it. So it would be something that we'd need to preemptively be doing and working with a specialist such as yourself to really understand that and to make sure that it's lined up. And then just on that point, I think it's important to mention, so there's obviously two sides to the coin. If there's a passive investor listening, they obviously want to cross-check with their operator prior to getting into the deal. How much of this are you taking? How much of this am I taking? Is it fair? Am I comfortable with that? There's more to it than just a kind of return waterfall or cash flow waterfall that lots of people pay more attention to and don't necessarily see all these other underlying benefits that could be taking place. So that sort of stumbles me into the next thing that's popped up in my mind, which revolves around, as a passive investor, where do I see this benefit? Does it come up on my K1 certificate? What should I be asking for from a sponsor to actually provide something to the IRS to get this benefit? How does this actually practically play out?
So I still do want to get back to the second, kind of downside, which we kind of skipped over because it's really exciting when we start talking about this. Just, go to one thing to the next.
You can go there first.
I want to get back to that. Yeah. No, I'll wait to get back to that because it's an important question here. And I think with this, we'll understand the other question even better. So I'm glad you asked this question because yes, that is correct. When you, invest in a property, you own a property, especially when it's a partnership, you get a K1 form on your tax return, which states how much income and how much expenses are, coming from that property. Depreciation is considered an expense, even though it's just a paper expense and it's just kind of like a theoretical expense because it does not actually reflect on your real returns. Okay. Yes. It just reflects on the kind of the paper returns. So yes, when you'll get your returns. So let's say you're investing in a syndication, you get an 8% return. Let's just keep it simple. $100,000 you put in, 8% return, you get $8,000 of money, okay, return to your pocket in that year. You will also get what the depreciation allocation is to you based on your percentage of ownership. If they're doing a cost segregation, most likely you're going to have more deductions than you will have income, which will translate.
Beautiful.
You will have a loss, okay, in your K1s, which that means all of that entire $8,000 will stay in your pocket and none of it will be taxable.
And
okay,
just as a caveat on that one, sorry, I know now I'm really just looping into loops, but as we speak, it's so interesting. I feel like we're going to probably run out of time. But on that $8,000 as an investor, am I able to, let's say, for example, my depreciation was $10,000 and negative by $2,000. You've already clarified that if I'm active in the real estate market, I can actually use that to offset all of my income. Now, if I'm not active in the real estate market and I'm a passive investor, can I use that to offset other passive income?
Other passive income, yes, but other passive income is defined by the IRS, a very specific thing. So what you may think is passive may not be passive. So stocks, for example, and things like that are not considered passive income. Other properties, any income from properties are considered passive. And if you have a passive investment in a business, for example, that may be considered passive, or royalties are another thing that are considered passive. Yeah. Well, for whatever reason, stocks and bonds and all kinds of other income coming from those are taxed differently than the passive income from property. So to answer your question, yes. And if you're a real estate professional, again, you can now use those to offset the other income. So what happens if you're not a real estate professional and you don't have any other passive income? You just invested in one syndication, right? One property, and that's it. So you got this negative $2,000. Where is that going? What happens to that?
Good question.
Okay, so that, well, I'll be asking the questions here, Rikki. So I'm waiting for you to tell the answer.
I love it.
But in all seriousness, that doesn't disappear, okay? It doesn't disappear. It's not like, you didn't use it, so you lose it. No, it actually carries forward. You don't lose it. So it doesn't hurt you to get extra deductions. So having that passive loss does not hurt you in any way. It actually carries forward, which means you can use that next year if you have extra income next year. After your regular depreciation next year, whatever is the losses that carry forward can now be used to offset, that passive income in future years. So, and that carries forward with you and goes with you continually until you either sell the property or it runs out. So once you sell the property, that gets released, and then that can be used, those net operating losses that have been carried forward can then be used at that point to offset other capital gains and things like that.
So on a practical level, let's assume I got $10,000 of depreciation. Year one, we make $8,000 in year one. In year two, we make $10,000. So I'm currently, if I'm accumulating, I'm still offset by the $2,000. And year three, hey, we got great rental bumps, or our value add program went well, and suddenly we made $12,000. I'm going to be able to carry that $2,000 over, and in year three, I still won't be paying any taxes on that income. And only from year four, assuming we create more income than the $10,000 being offset, we'll start paying on the differential.
Correct. Yeah. And the great thing about this is when you start having multiple investments, and especially if you are an operator, then that's really where cost segregation is going to benefit you the most, because, one, you're maybe front loading depreciation now, and after year five, you're going to have less depreciation later on. Or if you do the bonus depreciation, you front load it all into year number one, then in year two, you're going to have less tax deductions. But if you're buying another property or another investment, that depreciation can be used to offset all the income. So you start using this, strategy across your portfolio, and that's really where this kind of compound effect happens, that you're, just buying more, creating more income, and creating more deductions at the same time.
Okay. And I guess that leads us into what's the second negative thing about all of this, about depreciation. Where else did they catch you?
Yeah. So the second negative thing is that when you go and sell a property, not only do you have something called capital gains tax. So if you made a profit on the sale, you have to pay a tax on the amount, the difference between what you bought it for, what you sold it for. That's called capital gains tax. Okay? That applies in pretty much every country in the world.
Yes.
However, there's another tax that comes about, which is called depreciation recapture tax. Dun, dun, dun. It's probably like the worst thing, because it's all exciting about depreciation. depreciation. We're like, this is awesome, the best thing, since sliced bread. But really, when you look at the whole picture, and you really should look at the whole picture, you have to consider, well, when I take all this depreciation now, later when I go to sell the building, I'm not going to pay it back per se, but I'm going to now have to pay tax on that amount. So yes, I got around paying taxes now in these first 5 years, which was very beneficial. But
yes.
I should consider in my business plan what the outcome will be if I have to pay that amount of tax later on upon the sale.
Okay.
Now, in a bubble, where we're just looking at this one property and that's all you're talking about, and you sell it and you do the cost segregation. So that's correct. You're going to have this tax burden later on upon the sale of the property. However, there are so many other factors that come into play and other strategies that can come along with this that can actually totally wipe out that depreciation recapture.
Tell me more. Well. Tell me more.
So again, if anyone's listening to this, you obviously must speak with your tax advisor, your own tax accountant. Okay, disclaimer here, don't do anything. If you're doing your own taxes, right, you should, not be listening to this episode because you're going to probably be doing something wrong. However, there are strategies. And the first one is very simple, which is called a 1031 exchange. I'm sure, people know about this.
Yep.
If you don't, it's very simply that you can, sell a property, and instead of just selling it outright, you can jump through a lot of hoops and fill out a lot of forms and work with an attorney that actually allows you to, quote unquote, exchange the property for another property, right? Trade it instead of.
As an aside on the 1031, is that something Madison Specs also specializes in, or would that be a completely different group that would do that?
Yeah, well, so Madison Specs is a kind of subsidiary of a larger company called Madison Commercial Real Estate Services. So we all work under the same roof, but we're just, each one is a kind of separate company. So we have a lot of the executive staff is the same. We have a sister company called Madison 1031. So we are 1031 qualified intermediaries that we can do that as well. Madison Title also, we're one of the biggest national title agencies for commercial property. So but close parentheses. We back to that. When you're doing a 1031 exchange, you can literally trade a property. And so by, jumping through those hoops, you can get around paying capital gains tax and get around paying depreciation recapture tax. Okay. So we actually can defer that. And what we're doing by deferring it basically allows you to paying less taxes. Paying less taxes creates a lot more opportunity, a lot more income potential, a lot more value to the property that you buy. So that's one very easy strategy. Easy that, obviously it's not the easiest thing to do. There's a lot of rules and regulations to go into that, but it's very simple. The second way to get around it is a little more complicated, but it's something called partial asset disposition, which simply allows you when you sell a property and you've held the property for over 5 years and potentially even after 3 years, or some want to go as aggressive as even after 1 year.
Okay.
What we're doing in a cost segregation is we're saying we are identifying all this personal property, all the stuff that's in the building that depreciates on a 5-year schedule. And we say, we've assigned all this value, 20% of the building is in the furniture and fixtures and all that good stuff. After 5 years, from a tax perspective, it is logical to assume that stuff has no more value to it. Okay. Because you've already written off the entire value. And so from a tax perspective, that has no value to it. Now, this is where the partial asset disposition comes in. When you dispose of a property, so either when you dispose of it and you literally do renovations and get rid of it, you don't pay depreciation recapture tax on that because it's gone. You write it off from your books. So too, when you dispose of it in the disposition of a property, in the sale of a property, you can actually file a form. It's a special tax form that allows you to allocate little to no value to all of that personal property that has no more value to it. So what you're doing by doing that is you're saying all that stuff, I no longer have to pay any depreciation recapture tax on that amount. Because it has no value to it. So that's the second, more complicated way. Again, I say most big, accounting firms use this strategy, and some are more aggressive to even do this after 1 year to say, okay, 1 year's passed, it no longer has any value, it has a 5-year value to it.
Wow.
The third way, and this is probably another easy way, but it's more complex because it depends on a lot of other factors. I had mentioned to you earlier on that when you have that extra loss, and that carries forward. So that loss that carries forward can, is released at the sale of a property. It accumulates, and then when you sell a property, it's released, which means you can then use that extra losses at that point upon the sale to offset other income. So if you have more than one property, you have a lot of properties, and let's say you sell one property and you have a big tax liability, capital gains tax, and depreciation recapture tax from that, but you buy another property in the same year and do bonus depreciation, and you have all these huge extra deductions, you can literally use those extra deductions from property B to offset the gains and the tax from the sale. So literally by just playing a strategy where you're buying multiple buildings and you are playing the real estate game to use the taxes from one property to offset the gains, the deductions from one property to offset the taxes from another property. It's literally, that's how you play the game.
I suppose that's where the real sweetener of bonus appreciation probably comes in too, because if you're buying and selling in the same year and you potentially want to try get all of your bonus depreciation in year one on the purchase of the new property in the same window that you're selling the other one, that sounds like a recipe for success.
Absolutely. Yeah, it's huge. It's huge.
No, look, I think this has been amazing. I really find it valuable. So if you're looking at those different strategies for kind of tackling not having to pay this huge depreciation catch up, how soon in advance does someone need to decide on that? Is that something also that needs to be written into the operating agreement right from the beginning? Or is this something that you can kind of work out as you're going into the sale process?
You can work that out as you go into the sale process, but it should be something potentially considered, at the time when you're putting together your business plan. Right? And you're talking about what's my IRR going to be, what are my returns going to be? A lot of people write in the cost segregation into it and talk about how much more the IRR is going to be because over these years I'm going to be paying little income tax. And so therefore it would be, definitely be advisable to also consider writing into that plan, what will happen upon disposition, right?
Yes,
if I plan to hold this property for 5 years, 7 years, what are they going to be the situation, the tax liability upon the sale.
So practically speaking, at what point in time does it make sense to approach someone like yourself for the specialized kind of advice? And then the other layer is at what purchase price of an asset? Because obviously your services aren't free. Cost segregation is probably, it's a very professional based exercise that you guys need to go through. So in terms of an asset size, at what point does it make sense to look at spending the extra money on professional services like yourself to be able to actually get this benefit?
Yeah. So the first answer is a lot of people reach out to us immediately upon acquisition or immediately even upon going under contract in a property because at that point, first of all, even before you buy a property, it's good to know what the numbers are going to be. And so one of the services we offer is a free estimate, a free analysis of what you can see the difference between what your depreciation would be if you didn't do cost segregation versus what your depreciation, what your tax benefits would be if you did depreciation. So I highly, recommend reaching out to us at that point where you can already see what those benefits are going to be. Most people get it done in the first year. So again, immediately after acquisition is the best time to do it because even though you don't have to worry about this really until you're filing taxes. So if you're buying property, buying right now in June of 2020, you're not going to be paying taxes and the cost segregation is not going to affect this property until you file taxes for 2020. So ostensibly you have another, 6 to 9 months until you actually really have to worry about it. Nevertheless, it's good to get it out of the way right at the beginning so you're not, rushing in the last minute and trying to take care of it before the tax deadline.
So the only other thing that we would need to consider, I suppose, right at the beginning is from an operating agreement standpoint to see how that would be allocated among the members. But other than that, everything else could just wait up until it's pretty much the end of the tax year.
So that's for sure true. And then the other thing to consider, as you asked, was, at what price point does it make sense? Which is really important. My rule of thumb is really anything over $500,000 purchase price is where
it's
it starts making sense.
To entry. Yeah.
It is obviously for people who are just, doing single family rentals, it's going to be more difficult because yes, there is a fee involved in the service. We do the estimate up front right at the beginning, which will tell you what the fees would be as well as what your tax benefit will be. So at that point, it's pretty much, right ahead of time what you're going into and if it makes sense for you, if it doesn't. That being said, after, over $1 million purchase price, it's basically a no-brainer. It's just like, 10, 20, 30 times the amount of tax benefit versus the cost. Where it's just like, there's almost very little reason not to do it.
Okay, well, I'm going to leave it there. I'm extremely grateful that you're on today. I loved having you on the show and thank you so much for bringing all the energy. It was really great. And hope all the best for your podcast. What was the name of it again?
Weiss Advice.
Weiss advice. That's going to be some great advice coming through there. So you guys need to go out and listen to it. How else can people get hold of you if they're looking for your services?
Best to reach out to me at, you can find me at yonahweiss.com. So that's, I work for Madison Specs. So you can find us at madisonspecs.com as well. Or find me on LinkedIn. That's where I spend a lot of my time doing a lot of posting and engaging with my connections over there. So definitely happy to connect with you there as well.
Great. Thank you so much, Yonah. Appreciate your time.